In this video, I'll be revealing the specific $900,000 retirement plan that eliminates worry and creates confidence for retirees who thought that they didn't have enough to retire comfortably. Through working with clients who've achieved successful retirements with $900,000, I've discovered that strategic planning with this amount of money can provide more security and lifestyle than many people actually realize when they understand the right approach. That's exactly why I'm making this video today, to show you the complete $900,000 retirement framework that transforms anxiety into confidence and proves that this amount can support a comfortable and enjoyable retirement. Let's get right on into it. So you have $900,000 and you're wondering, is this enough to live the retirement life that I've always envisioned? Now, for some people, it might not be close to enough, but for many others, the math works out. And that's what I want to focus on today. Not only can it work, but most importantly, how? In fact, we've had plenty of clients who retire on $900,000 or less, and it comes down to a few key factors, which we'll talk about today. The first of them being how you manage your withdrawal strategy in retirement. Now, doing so correctly will allow you to position yourself in a way that allows your portfolio to grow while taking distributions out safely. One thing to note at this size of a portfolio is that even an 8% return on average will generate about $72,000 per year in growth over and above your principal. Now, of course, we don't rely on averages showing up every single year, and of course, this will also depend on your allocation. Markets are bumpy, not to mention you're most subject to sequence of returns risk as soon as you retire. But it's important to know those figures either way. And even more importantly, that's why we use a guardrails withdrawal strategy, which could look something like this. For example, if you wanted to start around a 5% withdrawal, that would be about $45,000 from a $900,000 portfolio. Then you can adjust spending as markets go up or down, and this, most importantly, will give you flexibility. Raise when times are good and protection when they're not. For most people who retire early, they're taking out 5, 6, or even upwards of 7% of their portfolio on a yearly basis before they get to Social Security age, and occasionally it's even more than that depending on the plan. But let's say for a moment you start your withdrawals at what we mentioned, 5% of your balance, which is a bit lower than you likely could, but let's start out small. That means you could spend $45,000 per year from that starting balance of $900,000 and adjust your withdrawals accordingly if the market goes up or down. This is what's called a spending guardrails method. It can help you stay safe in early retirement while still spending more than the safe withdrawal rate of 4%. And it's dynamic enough to give yourself a raise when the market does go up and takes you outside of your initial spending withdrawal levels. And once you claim Social Security, well, it gets even better. Imagine your Social Security income was another $3,000 a month on top of this, and all of a sudden now you're able to spend $80,000 per year before taxes. Now, to make a plan like this work, you can't simply be relying on 1 or 2 stocks or even just 1 or 2 asset classes to carry you through retirement and give you the stability that you'll need to spend comfortably and, most importantly, sleep at night. This is why the next key factor is how you set up your portfolio when it comes to withdrawing money. For many folks that want a more diversified approach heading into retirement, we want to balance things like US large, medium, and small companies, international large, medium, and small, maybe even emerging markets, real estate, and fixed income sources like bonds, CDs, government securities. That's why having diversification between these types of asset classes will help you to avoid what's probably the largest risk that you face as soon as you enter into retirement and before you take Social Security, which is sequence of returns risk, otherwise known as retiring at the wrong time risk. Now, if you're not familiar with what that is, this is the risk that the market goes down, or at least your portfolio goes down significantly early in retirement as you're spending money and withdrawing from your portfolio. For a lot of people, especially in this situation, you'll be spending more out of the portfolio before Social Security comes in and helps supplement your portfolio withdrawals for spending. That's why diversification is so important. For example, if US stocks go down in value in a particular period of time, whether that's a year, 3 years, or 5 years, oftentimes international stocks will behave in a slightly different manner and oftentimes significantly. Things like bonds, government securities, CDs, those will help keep your portfolio afloat, and you can live off those medium and fixed income assets while you wait for your stocks to recover in the event of a longer sustained downturn. So the reality is this: $900,000 isn't just barely enough. When managed right, it can provide you an income stream for the rest of your life. But income planning alone can't be done properly without considering how to protect your buying power from inflation. So we talked about how to build a portfolio and most importantly, how to generate income. Great, that's all well and good. But how do we ensure that it helps us sustain the same lifestyle 10, 15, and even 20 years from now? Because without the right plan, a dollar today could go as far as 50 cents in the future. For example, $100 in 2000 had the same spending power as nearly $150,000 in 2020. In fact, inflation is the silent tax on most retirements. And if your portfolio doesn't grow faster than inflation, you're not maintaining your lifestyle. In fact, it's slowly shrinking. This is why inflation protection has to be built directly into your plan. That means resisting the temptation to go ultra conservative with your investments, which will hinder you for the long term, although it might feel good immediately. Yes, bonds and CDs certainly have their place, but if they're your entire portfolio and they're only generating, let's say, 3%, and inflation is anything above that, well, you're losing ground. Not to mention that when you run the numbers, inflation being higher or lower than expected can significantly change the income and spending outlook for your retirement. That's why one of the what-if scenarios that we run for our clients is this. What if inflation rises to 5% on average throughout the rest of my life in retirement? This is a good argument for including stocks and equities in your allocation for your portfolio, rather than hunkering down and owning as much fixed income and conservative assets as possible. But at the end of the day, it's a balance. We don't want to have so many stocks in the portfolio that your investment journey is way up and way down, and you're bleeding dollars from the portfolio in times where there's bear markets or a sustained drawdown. Not to mention, there's a sleep at night factor to all this as well. So here's how that could look in what's called a 3-bucket approach. Now, you can have something like cash, high yield savings accounts, CDs, short-term bonds, and a short-term bucket. For your medium-term bucket, if you're not totally dissatisfied with bonds, well, that's the place for them to go. And lastly, for your third or your long-term bucket, that's where your equities can belong. They can help you outpace inflation and, of course, not lose spending power over time. And when the stock market is up, we can either rebalance into bonds if they've lagged far behind, for example, or we can take income from that stock portion of our portfolio, or sometimes even both. Inflation protection preserves purchasing power, but geographic optimization shows how location choices can help you maximize your money even further. Now, it's no secret that where you end up living in retirement has a lot to do with whether or not your spending levels feel reasonable or not in retirement. And over the years, especially recently, we've had a handful of clients that not only have chosen to live in different areas of the country, but others that have even chosen to live in places outside the country, like Panama, Spain, Mexico, etc. Now, of course, those retirements are going to look and feel a lot different than living in somewhere like Southern California, New York, Boston, Philadelphia. You get the point. Now, that's not to say that you can't retire in any of those places, but it does mean that as you make a decision about where you want to be in retirement or how you want retirement to look, one of your options for making that work could actually be moving to a new location. Some of the places in the US that a lot of retirees are moving to include states with no income tax. Places right here like Tennessee, my home state, Texas, and Florida are great options for eliminating that additional cost of state income tax. Of course, beyond just a lower cost of living and taxes, you want to also keep in mind everything else like property tax, sales tax, and yes, most importantly, weather. This part of your decision is strictly based on what's important to you. If living in the same place is extremely important, then moving is obviously not an option, and that's not something you should bake into your retirement. However, you have to think about the trade-offs of any of these decisions, whether it's moving or staying in place, and how that affects your overall retirement, whether you need to work longer to save up more, or whether you might actually be able to retire sooner. At the end of the day, it's a trade-off discussion. And speaking of trade-offs, if you're wondering whether or not you should do this yourself, or if you'd like a second set of eyes on your plan while you build your dream retirement, click the link below to schedule a call, and I'll show you exactly how to create the retirement lifestyle that you've always envisioned. The other big piece of this equation for making this $900,000 retirement work is how do you optimize your Social Security decision and make it work for you? Oftentimes, we talk to clients that want to take Social Security as early as possible. And on the surface, that can make some intuitive and logical sense. There's things like health concerns, or a spouse having a larger benefit, or a few other factors that really truly could be the best option. However, that being said, when you have a portfolio around this size and you're in this situation, oftentimes claiming Social Security later is going to allow you to spend more now and in the future, knowing that your Social Security benefit is going to be substantially larger by delaying it. And if you know your benefit is going to be substantially larger at either full retirement age or age 70, then you can count on it being able to take over the majority of the load for your spending later on in retirement. Accompany that with smart asset allocation, and it can give you the capability to spend early in retirement and also give you the buffer that you need to get Social Security benefits in the back end later on. Once you receive your Social Security benefit later, it'll ease the pressure on your overall portfolio, which will lower your withdrawal rate and allow you to take out less to cover those base expenses. And when you claim those Social Security benefits later on, it will ease the pressure on your portfolio and your overall withdrawal rate, which will allow you to take out less from the portfolio as you cover your expenses. But like I always say, Social Security is a lever. If you plan to take it later, but a sustained market dip happens, then you can decide to pull it earlier if it's beneficial for your plan. Think of it this way. Your portfolio provides flexibility, but Social Security provides guaranteed inflation-adjusted income that lasts as long as you do. Together, they're far stronger than just one of them alone. Outside of taxes, one of the things that worries retirees the most is healthcare costs. And it's certainly understandable. As you age, healthcare costs can also increase as well. For most clients, our baseline is that we assume that you'll spend at least $12,000 per year in healthcare costs once you're retired. And going back to inflation, we even assume that healthcare costs grow at a faster rate than what normal inflation is to align with the reality that healthcare costs have risen faster than most other services out there. That being said, health savings accounts, or HSAs, can be used to pay for procedures and services completely tax-free, and the medical emergency fund can help you create a buffer between your health costs and your investment portfolio to ensure that we're not dipping into those assets that are intended to grow over the inflation rate for the long run. So now that you understand the importance of healthcare cost management, let's look at the complete implementation framework to make this retirement a success. Here's the big picture of how this all works together. First, you want to use a withdrawal strategy that works for your plan, and you can implement a guardrails approach to generate income to allow you to have a dynamic spending model in retirement. Next, you want to make sure that your portfolio is prepared for inflation. Keep your short-term needs in cash, your medium-term in bonds, and your long-term in equities to preserve your buying power without taking too much risk. And if it makes sense for your situation, you can maximize your dollars even further by choosing a tax-friendly or cost-efficient location, or heck, even an international option if that's of interest to you as well. Next is you want to optimize your Social Security plan, and most importantly, your Social Security timing, so you can use portfolio income to bridge those early years and claim later for maximum lifetime benefits. Setting up the right strategy can help you optimize your overall plan, and it's an important decision that you really want to make sure you take time to make. And lastly is healthcare planning. You want to build predictability with Medicare supplements, HSAs, and potentially even a long-term care strategy, which, again, planning for the best while still preparing for the worst will help you avoid some of those healthcare surprises that can jeopardize even a stable retirement. And when you implement these together, $900,000 transforms from a number that makes you wonder, is this enough, into a plan and a framework that gives you confidence. So now that you understand the complete $900,000 retirement plan that can help you retire more confidently, you can see how strategic planning with this amount of money can help you provide more security and lifestyle than most people actually realize. And if you want help implementing what I talked about today and creating the worry-free retirement that you deserve, then click the link below and schedule a call, and I'll be happy to show you exactly how to make it happen. Thanks for watching. I'm Kyle Kuyat, and I'll see you in the next video.